Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for about the next 30 minutes here on Options Guide TV. Today's date is December 15th, 2023. S&P 500 index has gone up 7 straight weeks in a row. So it's safe to say that all the data that came out last week, including the Fed meeting and the press conference afterwards, the market seemed to like. CPI numbers, PPI numbers, all of them came in line. They were solid, and the market took it well. As a matter of fact, we saw the 10-year yield collapse instantly after the Fed came out and started speaking. So that was a down day for interest rates in the bond market and an up day for the stock market. A lot of the Magnificent Seven stocks have done well. The Dow hit a new all-time high, which is just references 30 stocks, but it's still worth noting. So the markets are definitely in a bullish trend, and that's kind of what we were looking for here on Options Guide TV going into November and into the end of the new year. A lot of people have a lot of cash on the sidelines, and it's very interesting to see what they might do with that cash at this point in time. And so because of that, we've done a few bullish trades in the SPX. We did a skip strike butterfly, and we did a long call spread, both on separate weeks. So that goes back, let's go back about 3 weeks ago when we started that process. Last week, we took the time to add to some positions in our paper trading portfolio. And we do have a paper trading portfolio, which is wonderful with the TradeHawk software over at Tradier, is that you have a portfolio that you can put together that looks exactly like the normal portfolio. There's just a few quotes that are missing on some big indexes. And that's mainly because you have to pay for those quotes. But inside the paper trading app, you can learn all about the TradeHawk software, which is a very impressive software in general. And so when we're trading in the paper trading portfolio, we're buying deep in the money calls and selling shorter term calls against them. That strategy in the playbook is called the fig leaf. So we're going to build out this portfolio over 2024. We're going to watch it for a year. We're going to maintain it. We're going to manage it. We've had to do a lot of managing recently because the market has been up. And so a lot of the stocks in that portfolio have all done very well. And we had some short calls against them. And we've had to actually roll those calls and deal with the fact that we've been right on the direction on a lot of our long call options. Well, the market's been right. It's easy to get things right when the overall market is going in the right direction. Let's put it that way. So today, I've got a busy show. I want to start by going to the options playbook and talking about the skip strike butterfly with calls. I want to put another one of those on. And then on Monday, we're going to come back and we're going to actually add a long call spread. So for the first week, we're going to be, I guess, bullish squared. We're going to do a bullish skip strike butterfly. And we're also going to do a bullish long call spread. So you're seeing on your screen right now, here's the options playbook. And I do always want to highlight this, is that Tradier is the main sponsor of Options Playbook. And if you want to sign up for their account, go right to the homepage and click on this, and it'll take you right into the app, and you'll be supporting Options Playbook and also obviously supporting Tradier brokerage. So they are my broker of choice. I also use them. I'm actually doing a transfer of an account that's going to be there by the beginning of the year. So I am using Tradier, and I would recommend using Tradier. I love this paper trading app feature to go along with all of the what if calculator and all the option tools. Obviously, Tradier likes to specialize in option trading, and that's their main client that they like to talk to. So part of the reason why. Also in here, we highlight that we do have the education. If you click on this, this will take you right to the Tradier Hub, and we're going to be building that out in 2024. Very excited about what we are going to be offering in 2024 inside Options Guide TV, which is inside the Tradier Hub. Okay, that's it for my little commercial. let's look at the skip strike butterfly. So I like butterflies. I like butterflies to learn. They are an extremely interesting pricing mechanism for the floor. Butterflies have to be priced correctly. If not, then floor traders, there's opportunities, right? So when you look at a standard butterfly, you, in theory, can never get a well, I should say, and in this day and age, it's almost impossible to get a standard butterfly, which is, a 10 point wide on both sides butterfly done for a net credit to the account. You cannot do that. Markets are too efficient in this day and age. Back in the day, there were inefficiencies that would allow it all as one trade, sometimes even, but you cannot do that now. And ideally, if the only way you'd be able to do it is if you were to leg into a trade, no market maker on the other side of that trade is going to allow it. But the skip strike butterfly is a way to do it. We're going to embed a short spread inside the butterfly, and hence we skip the strike. A normal butterfly, if we look at it, and here's the options playbook, option strategy, skip strike butterfly. Some people call it broken wing. I don't like that at all. I guess if you look at the graph, that could be a way. I like skip strike because that's literally what you're doing. Normal on a standard butterfly, you're buying strike A, selling to a strike B, and buying one of strike C. We skip that strike, so this side is twice as long as this side, and we buy strike D. Hence, what that does is it puts a credit spread from strike C to strike D inside the butterfly. It embeds it, which means you bring in a credit. Ideally, we want that credit to be more than what the cost of the butterfly is. And when that happens, you can get it done for a net credit. And then this side of the graph is actually going to be above the x-axis, meaning that you're profitable if the market is below strike A. So when we're setting this up, we're targeting, if we're going to want to be bullish, which that's our attitude in the marketplace today. If we want to be bullish, we're going to, the stock's going to be all the way down here somewhere, right? It's going to be that, well, this direction, I guess, on mine. Well, let me see. Okay, I'm pointing the right way. So if we're going to be bullish, we're going to, the stock's going to be, the stock, and in particular, it's going to be the SPX. This is my favorite index to actually do, well, not just skip strike butterflies, but I do like to trade in the SPX. I like the markets. I like all the expirations that are available. So the SPX will be somewhere down here, and we'll hope that the marketplace comes up towards strike B. But if it doesn't, oh well, we did it for a net credit to the account. So you can look at this, and I don't want to beat a dead horse because I went into a lot of detail the last time we put a skip strike butterfly on, but you can look at this as we're going to modify a butterfly and make it a broken wing, or you can look at this as we're a short spread seller of calls. We want to sell a short spread, but oh, by the way, we're going to embed a butterfly in there. So if I just wanted to be bearish, neutral to bearish on the marketplace, I could just sell a short call spread. And that would be basically selling strike C and strike D and embedding that, or just doing that short call spread. This is an interesting alternative to the short call spread because as expiration approaches, if the market is going against you, this trade actually is profitable. So I like this as an alternative to the short call spread trader. And I'm sure there's a lot of short call spread traders out there that have never thought about a butterfly. You do need to have some premium. So SPX is a 4,600, maybe 4,700 at this point in time point index, and that adds premium, and premium helps set up these butterflies. I prefer to do it the VIX with the VIX around the 15% or around the 15 level. The fact that the VIX is now down around 12, it doesn't hurt things. I don't want it down around 9. Wouldn't be that excited about it. But if the VIX actually is trading at a little bit higher level, I find these butterflies a little bit more interesting to do. So that's going to be the strategy for the day. One little tangent that I want to go on, though, is, and this is just based off of the news that we saw from last week. So we now start the new countdown. This is the CME group. This is the Fed Watch tool. I love this little countdown. If you ever want to know when the next Fed meeting is, all you got to do is run to this site, and it actually gives you a countdown to the next Fed meeting. But more importantly, it shows you what the futures market thinks of possible rate cuts or rate hikes. Used to not get a lot of play because the market never did anything. But obviously, in these times, every Fed meeting is usually quite interesting, especially to hear the comments afterwards. So it was without a doubt that they weren't going to do anything this Fed meeting. The marketplace showed that. The CME Fed Watch tool showed that, and they didn't. They came out and they said there's not going to be any adjustment to the Fed funds rate. Now, on the January 31st meeting, which is 47 days, 2 hours, and 43 minutes away, they say that there is also a probability that that they're not going to be raising rates at all. So this is the current market, 525 by 550. That's the current Fed rate. And right now, what they're saying, Fed funds rate, that's the word I wanted, 85% chance of that. There's a higher chance that they might actually do a rate cut now by that January meeting. It's only about a 14% chance, but notice there's no probability of them increasing at this point in time based off the futures market. Now, this becomes more and more accurate as that expiration approaches. But what I find very interesting, and this really jumped after the Fed spoke on Wednesday, after the conference call, is the March probability of a rate cut jumped from about 47% to 64%. So now if you look at March, what they are saying is that 525 by 550, that's the current rate. There's only a 25% chance that they do nothing. There is a 64% chance that they will cut by 25 basis points. And there is a 10% chance that they could cut by 50 basis points. So that definitely took a turn on Wednesday after the meeting. And so I thought it was worth bringing up. And this is part of the reason why the markets have been bullish. Obviously, a competitor of the stock market is the bond market and interest rates and yields. And if you're getting, 5% on a 10-year T-bill, which you did have that possibility of doing not that long ago, that's obviously a headwind for the market. Now we've seen the T-bill come all the way back down closer to the 4% level. The skew between the markets, between the short term and the long term, has started to come in. And a lot of people are now saying that the soft landing is in sight. And once we start seeing the rate cuts, I guess everybody's going to see exactly how the market reacts to that. And that will be a good determination of if the Fed did, quote unquote, pull off the soft landing. Okay, so now let's take a second. Let's move out a little bit here. And we're going to run over to the TradeHawk software. And I was a little long-winded, so I'm going to have to hustle to try to get everything in today. And all right, so now I have the test portfolio up. This is not the paper trading portfolio because I like to trade in the SPX. You can do these trades in the SPY, but I always have to emphasize nothing's meant to be a recommendation, right? You have no idea what your portfolio looks like or whatever. All this is a learning experience here on Options Guide TV. But we have the market right now at 47.21. If you look at a lot of the charts just on stocks in general, you just see strong moves up in the S&P 500 index. And this was obviously, it was battling for, we were right around 4,600. It really struggled to try. Well, it didn't really struggle, but it definitely was a place of resistance. Nice big round numbers usually are. Back here, we bumped up against it. We are now seeing the 50. Well, let's add actually some days to this. Let's do 800 days here, a couple of years. And you see the ducks are getting in a row, right? We have the 20-day, the 200-day moving average is now below the 50-day moving average, which is now below the 20-day moving average. Sign of a healthy market. And it's nice to have our ducks in a row. And we had a nice strong move. So if you go all the way back from 4,600, look at this area here. A lot of noise right around this 4,600 level. And boom, we were all the way up to 4,720, as I mentioned. So we did have a real strong market. Obviously, this will be the next headwind, 4,800, with the looking to try to get to an all-time high in the S&P 500 index, which trying to do that during a recession, that's pretty impressive. Just in general for the marketplace, it's showing a lot of resilience. Okay, now let's get back to the trading. Skip strike butterfly. Want to get it? Want to get this trade on? I know I'm being a little bit redundant with the strategies, but if you were in a strong bullish market, this is where I want to play. This is where I want to be. We'll do the paper trades. I will sell a call in Home Depot and in Lilly today because I did not do that on Wednesday's show when we put on those positions in the paper trading portfolio. I'm not going to run over the paper trading account. One of the downfalls is I can't be in the paper trading account and in the test account at the same time. So I'm going to add those, but I'm going to show you the options that I would sell against those positions. Okay, so SPX. To start with, we want to know where a 1 standard deviation move is. So here's the options grid inside the TradeHawk software. These are real-time quotes. If we hit this and we look at the expirations, we have all the different expiration dates available. We have all the different strikes available. But what I always like to look at is the shading. So we shade a 1 standard deviation move. And I think this is a wonderful feature of the TradeHawk option chains, or i.e. the options grid. So the market is at 47.20 right now. We're going to go out about a 1 standard deviation move away. We're looking at the December 22nd expiration. That's 7 days away. I mentioned this the last time around when we did a skip strike butterfly, that I don't mind doing the skip strike butterfly on a Monday, but I don't, or on a Friday, I'm sorry, but the long call spread trade, the speculative long call spread trade, I like to do on Mondays. I don't want to go over a weekend in that long call because I want to adjust that quicker than I would have to in the skip strike butterfly. The skip strike butterfly already has the adjustment in it. And the last one that we did worked out very well in that the market actually went down, which helped a little bit, and then came back up. And that's ideally what you want with a skip strike butterfly. And I'll explain that why when we get to the what if calculator. Okay, so let's scroll down to the shaded area. And I always like to note where the delta is at, because a 1 standard deviation move means that the delta should be right around 16, implying there's a 16% chance that the market can finish above this strike, which is 47.85. Okay, so that's right. It's looking good. Right in this range is somewhere between these two strikes is a 1 standard deviation move. It's not an exact science. Well, I guess you could get technical and say that you can get an exact number if you want to take the time to calculate it. But it's dealing with you're dealing theoretical concepts in a real marketplace. And the markets don't always act the way that the theory says that it should. Or this would be extremely easy to do if it always did what the theory said. All right. 47.80. So this is where we're targeting. That's a 1 standard deviation move away without any major news events, which this is part of the reason why I didn't want to do anything this week, is because there was so much news in the Fed meeting. So we avoided that. So we're now back in. We got the news. The market has reacted positively. We set a new high in the Dow. Time to do another one of these. So we're going to buy the 47.80s. We're going to buy one of those. We're going to go up to the 47.90s, and we're going to sell 2 of these. So if I click on it twice inside the TradeHawk software, it puts a green buy under the spread column, and it does a red sell right there. Now, a standard butterfly, and I think always it might be worth, let's just plug this in, and then we're going to just look at the price. So if we did a standard butterfly and we bought that, that would cost us 50 cents to put the trade on. That's fine. That's an okay trade. I don't mind doing it. You're risking 50 cents for every 1x2x1 butterfly. That's $50 plus any commissions or fees that you might pay to put that on. So $50 is what you're risking. If you did it 10 times, it would be $500. Now, if we change this up a little bit and we skip this strike, what we're hoping is that this credit spread from 4,800 to 4,810, that credit spread pays more than 50 cents. And it will. Normally it will. I haven't actually laid this one out yet. So let's go in and put this in. 46, which one is this? 4,800. We want to get rid of that. Okay, so now we're going to skip that strike. And we're going to come in and we're going to buy the 4,810. So let's put that in. And if we do that, now we see this went from a 50-cent debit to a credit at the midpoint of 55 cents. I was hoping to get somewhere around 60. We got 60 the last time around when we set this up with basically the same scenario. So we're close to 60. Okay, so let's call it 60. Let's keep it there just to keep the math simple. Okay. You usually get good fills, especially in the SPX, if you come with a multiple leg trade to the floor. The more legs you add in the S&P 500 index, the good old SPX, the better the fills are. So you're giving a package of options that you're taking to the trading floor. You're already giving the market makers their hedge to help trade against you. And the odds are very high in the SPX that you're going to be trading with somebody that is on the floor of the Chicago Board Option Exchange, CBOE Global Markets now, I guess. I really wish they would not change the name. It was a good old name, but they have. All right, so with that, I digress. 60 cents, and it's jumping all the way around, but this is where I would put it in at. So here would be our paper trade is we are buying December, and I always want to make sure that this is right, December 22nd, which is the Friday expiration. SPXW, which also means that it stops trading on the close on Friday, because there are some options in the SPX offerings that do stop trading on Thursday, and the settlement is determined on Friday. So you always want to make sure that there's a W in the SPX name. That's the ones that I like to trade. So we're buying to open the 47.80 strike call of the December 22nd expiration, then selling 2 of the SPX, the same expiration 47.90 calls, and then skipping the 4,800 and then buying the 4,810. We're going to do this for a net credit to the account of 60 cents. So that's going to bring in $60 into our account. We are going to have a margin requirement. Basically, that short spread that we embedded from 4,800 to 4,810 is going to be a requirement. That adds risk to our trade, which we'll see in the what if graph here in a second. But when we do that, they'll be holding out $1,000 minus that 60 that we brought in. But we only get hurt if the market goes above 4,800. That's where that starts hurting us. So we were talking about going all the way through the 4,700 level, busting out of the 4,800 and going up to the 4,810. I like the outlook of this trade considering where the markets are at. So if the market just goes down, we make the 60 cents. If it stays where it's at, we make the 60 cents. If it comes up, lands somewhere close to the 47.90 area, close to expiration, well, then we have a potential to make an extra 10 points on this trade, which would be the maximum. And just don't ever think that you're going to make that. You really should be out of the trade long before that, because you'd be very profitable and there's no sense risking it to try to make the maximum on the trade. So here we go. And before I send this, because we are running out of time here, I actually don't think I'm going to be able to show the positions that we are sending, but for the paper trade portfolio, maybe I'll wait till Monday. That's all right. I don't mind waiting. Let's put this on, and I'm going to zoom in. This is where the market is at, and this is what I'm talking about. Okay. When you first put on this trade, the market's at 47.23. If the market skyrockets up to your 48, well, what's our middle strike? 47.90. This trade loses money to start with. So right off the bat, if the market just hangs over the weekend or even goes down a little bit, which the last time we put it on, the market went from 47.20 and down about 20 points. before it started coming back up. And so that actually made us profitable almost instantly. When the market went down a little bit, we actually could have closed out this entire trade and made half of the premium, which was around 60 cents. Market then started drifting back and then came all the way up to this level. The trade actually, at one point in time, we could have taken it off for a credit. We put it on for a 60-cent credit. We could have actually closed it for about $1 credit. And then eventually it expired worthless. It never made it all the way up to this strike. And we ended up making 60 cents on the trade. Not a bad day's work, right? Or a week's work. But that's the way the trade all planned out. So what is our risk? Our risk is that we have a gap opening more than a 1 standard deviation move in a major index all the way up to the 47.90 level, basically so quick that we can't react to it. That is what our risk is. That is our main risk of this trade. So it's very odd in that if you come in tomorrow or on Monday and the market is up 20 in the SPX, which is a very possible percentage, the trade will be down, but time decay will start working for you. So even though it was up and it hurt the trade, in theory, it still can help the trade if we get this time decay. So eventually the green line showing the what if the market moved to this direction on Monday or early next week, this is showing you where we'd be at and where our loss would be. And then as time approaches, eventually this green line is going to morph into the yellow line. So very interesting trade. If you just did a short spread, you would be down. And if the market bounced all the way, let's say it's trading right around here at around 47.70, right? You might be hard pressed to just take the position off. If we got that type of a move up 50 points in the SPX, you get a little nervous if you're just in a short spread, but you're okay. And the skip strike butterfly, I don't mind it. I don't mind it as bad. I still have risk. I just need time decay to work for me. So time decay is your friend. And the trade lasts 7 days. So it's going until next Friday when you put the trade on. There's obviously risk on this, and the odds, if you can get somewhere in this, if the market does go about a 1 standard deviation move and it lands somewhere within this range, well, that's wonderful. That's wonderful. You just take the trade off and you say, yeah. But our whole goal here is ideally, we'd like to make at least that 60 cents that we brought in for the net credit from putting the trade on. All right. So I did talk, I think I talked a little bit too long about the markets. So if you have any questions or comments, please try to put them in the chat box. I didn't really ask for them during the show. Like I said, I knew it was going to be a struggle to try to get everything in. On Monday, I think we'll wait the weekend. I'm okay with waiting the weekend. And we're going to look to add some positions to our long calls in the paper trading account on Home Depot and on Eli Lilly, LLY. And yeah, that's it for this episode of Options Guy TV. So please click subscribe, ring the bell, and pound the thumbs up. That helps us out quite a bit here on Options Guy TV. And we'll see you this Monday for the next edition of Options Guy TV. Thanks for coming, everyone.